Welcome to the Daily Drawdown, where SpaceX policy and capital flows are moving markets fast. The biggest practical story right now is that one IPO just changed market structure, options flow, and sector liquidity all at once. At the same time, Washington is leaning harder into AI controls. The Fed is reopening the balance sheet question, and oil just got a fresh geopolitical discount. SpaceX came public at a scale that immediately put it above roughly $2.5 trillion in market value, briefly ahead of Amazon and Microsoft and straight into the top tier of global public companies. The deal priced at $135 traded above $200 within days and raised about $85.7 billion after the green shoe was exercised. So this was not a normal hot IPO, it was a capital event big enough to redirect flows across the tape. What matters most is the float. Only about 3 to 4% of the company was actually available to trade at launch, which means passive index inclusion and retail demand were forced into a very small supply of stock. That creates squeeze conditions now, and then a separate risk later when a much larger block of locked-up shares can start coming free as early as August in some reports. It also created an oxygen-sucking effect inside the space trade. Smaller names like Rocket Lab and Intuitive Machines are already feeling the liquidity drain as investors crowd into the flagship. Options only added fuel. In the first sessions, reported volume ranged from about 700,000 contracts to nearly 2 million, with call buying leading early and short-dated speculation dominating the flow. Premium traded ran into the billions, implied volatility spiked well above the S&P, and that matters because listed options can keep a meme-style feedback loop alive far longer than a simple IPO pop. The near-term watch list is straightforward: index inclusion pressure, whether the call frenzy cools, and how the market prices the August lockup release risk. Longer-term, managers are arguing you have to underwrite this on a 5 to 10-year view around launch, data center ambition, and execution, not on a week one scarcity trade. Under the surface, AI hardware economics are still shifting in a way that favors memory in inference racks. Memory is now taking a majority share of component costs in some estimates, far above what investors are used to from smartphones or older compute cycles. That helps explain why memory prices have jumped so hard, with some reports citing roughly 70% increases, and why suppliers still have near-term pricing power despite the sector's history of violent reversals. The practical read-through is that AI demand is no longer just a GPU story. It's also a memory, storage, power, and specialized CPU story, and the bottlenecks are moving through the stack. Qualcomm is trying to meet that shift from both ends. It announced more than 40 AI device designs across glasses, wearables, and jewelry. And it's also building a custom data center CPU for workloads GPUs don't handle efficiently. Rumors of a large Tensorin deal point the same way. Qualcomm wants more engineering depth and less dependence on ARM as it pushes into edge and data center AI at the same time. The policy backdrop got more restrictive. Anthropic halted global access to its two most advanced models during an export control standoff after Commerce pushed companies to block foreign national access to sensitive systems. Why that matters is bigger than one company. Washington is moving toward treating frontier models more like strategic assets, with pressure for tighter access control, more transparency, and even discussion of public equity stakes as a national security tool. There's also an inflation angle investors should not ignore. Analysts are warning that after 2026, AI could start showing up more clearly in inflation through data center energy costs and expensive memory, even if official CPI struggles to measure quality improvements cleanly. On the macro side, the Fed's chair transition is less about an immediate rate move and more about credibility, communication, and the balance sheet. Markets mostly expect no fast policy change, but the new chair is signaling a stronger willingness to shrink the Fed balance sheet, which reopens quantitative tightening as an active tool separate from rates. If the Fed steps back faster as a Treasury buyer, long yields can reprice higher. That is the practical market consequence, especially if communication is sloppy or the pace feels abrupt. The caution from analysts is that monetary policy still works with long lags, so a calmer geopolitical backdrop is not by itself a clean argument for premature rate cuts. Oil took the geopolitical news first. A tentative U.S.-Iran memorandum includes a 60-day toll-free Strait of Hormuz arrangement while talks continue, and the market immediately started discounting the possibility of more Iranian barrels returning. Estimates suggest about 1.5 million barrels per day could come back over time, which is why WTI moved down into the mid-70s and why some bank targets have been cut. The catch is execution. The draft appears light on firm nuclear concessions, U.S. intelligence is skeptical on compliance, and the last chunk of production ramp could take months anyway. Beyond oil, copper remains firm on AI power demand, infrastructure, and defense spending, while gold has come off prior highs and stays sensitive to whether inflation and energy reaccelerate. The broader equity tape is also changing. Cash is leaving money markets, and leadership is broadening into small caps, equal-weight indices, industrials, and other second-order AI beneficiaries instead of just the giant software and chip names. That fits with the evidence from new highs in non-tech stocks and with investor preference for infrastructure, power, transport, and consumption-based software over narrow AI concept trades. In market plumbing, regulators are trying to make U.S. listings and new products more workable. The SEC is discussing lower IPO frictions, simpler disclosure, and even semi-annual reporting, while the SEC and CFTC are signaling cooperation on crypto and prediction markets instead of reflexive turf fights. That matters for Coinbase and Robinhood. Coinbase is pushing one-to-one backed tokenized stocks and retail access to pre-IPO exposure through perpetual futures, while Robinhood is cutting 10% of staff and leaning harder into product velocity as prediction markets are expected to grow sharply. If the Clarity Act advances, the practical upside is clearer stablecoin treatment and easier institutional custody of Bitcoin, which supporters see as a setup for stronger wealth management adoption and ETF flows. The setup from here is pretty clean. Watch SpaceX float dynamics, Fed balance sheet messaging, and whether oil's discount holds. That's the Daily Drawdown view for now. Thanks for listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.